Are you concerned about overpaying in taxes? You have done a great job of saving in your IRAs, your 401ks, and all of those qualified or deferred accounts. Now comes the time of your nearing retirement, and you know you're going to have to start pulling some money out of those accounts, and you don't want to go through a tax bloodbath. If we haven't met, my name is Tony Hansman, and I'm a financial advisor. We own a wealth management firm, and we help families just like you with tax planning. So apparently you're not getting help from your tax preparer, your CPA, and your current financial advisor is just saying, don't worry about it. Well, in today's Can I Retire, we're going to focus on income planning, investments, but most importantly, tax planning. So don't go away. You're going to really like this episode. Let's dive right into it. Below you can see in this hypothetical case, we've got John and June hypothetical. I've got John here. He makes about $150,000 a year. He is 61 years of age and he wants to retire at the age of 65. John's happily married to June. She makes about $50,000 a year. She's 61 as well, and she wants to retire with him at the age of 65. Let's take a look at what their Social Security benefits are going to be. I've got John here first, and he's going to have Social Security benefits, he believes, right around $4,000. And June thinks that hers is going to be about $2,000 a month. Now, when we first took a look at this, they were adamant about waiting till 67, their full retirement age, before they would start taking money out. And it doesn't bother me, but I do like to be able to help families maximize their Social Security. And I've seen so many families not do this. So frustrated, I actually ended up writing a book called The 7 Paths to Maximizing Your Social Security. And in there, we want to be able to, since we put so much money into the program over our lifetime, we want to get the most out of the program and not miss out on dollars. So we want to use sophisticated software that's going to help us determine when the best time to turn it on. And by simply asking them to change from what they thought to maybe a couple years earlier, and that's not the case for everybody, but in this particular plan, it actually made the money for them last about 5 to 6 years longer and help them in their overall plan and increase their probability of success. So it was a no-brainer for them. They said, we got it, Tony, we agree with you, let's turn it on at 65. So again, that's not for everybody, just this particular case. John's going to have a pension, you can see right here, of about $1,000. We're going to turn that on at the age of 65 for him. And if something does happen to John, his wife, June, will get 100% of the benefit. So let's take a look at tab 2 right up here at the top. And let's take from a 30,000 foot view of what's going on in their overall plan. How much money did they save? And then you can compare your own plan if, should I be doing something here in my own plan, what you're seeing on this today. So I've got John here, and in his 401k, he has about $750,000. And he's got about, 4 or 5 years left before he retires. So he's still putting about $1,000 a month into his plan up to the match. Very clear here. This is where a lot of people have a mistake. They're overfunding their 401k. And it's best for most people to only be putting up to the contribution limit. So if your employer does 6, you want to do 6, and then take that overage that you were thinking. If you were putting in 10, just redirect those dollars into tax-free buckets or someplace else. Because what's happening, most of you have a big IRA or a big 401k and a little tiny brokerage account or after-tax dollars, and if you're lucky, maybe none or a very small Roth account. So be thinking about how you're contributing to your 401k. Get the free dollars every single time. I'm not saying miss out on those, but be careful of how much you're putting into them. The other thing is inside of a 401k, most people use target funds, and I'm not a big fan of target funds at all. I can prove to you that they have underperformed over a history of time, and there's other things inside of your 401k that you should be considering. Now, let's say that you move that 401k out and into an IRA. The second thing I absolutely I'm not a big fan of are mutual funds. I want you to pause this video right now, go get your statements, and I want you to take a look at your statements and see if you have mutual funds in them. It'll say something like A, B, C, D, X. There's an X at the end of that symbol. Most likely it is a mutual fund, right? Those are, in my opinion, dinosaurs. There's things that are much more efficient and lower cost that I think that can improve your overall financial situation. Then, if you have 2 or 3 accounts with wherever you're currently at, go see if your advisor is using the exact same funds in all 2 or 3 different accounts. In my opinion, that's a big no-no. You should have, each account should be diversified for you in different types of money managers or in different positions. So again, go do that. Pause the video right now and go do that. That's super important. Now moving on. June has a 401k. She has about $150,000 in her 401k, and she's doing up to the match, not a dollar more, into that plan. They also have a brokerage account. This is after-tax dollars of $150,000. And then they also have in their bank, which is going to be savings, money markets, etc., CDs of about $75,000. So this 61-year-old couple has a liquid net worth of $1.125 million. They want to know, is this enough? Do I have enough to retire? And how do I reduce my taxes on all of this money, Tony? They're blessed that they've got a house that's paid for free and clear of $725,000. And if I scroll down, you can see they have a total net assets of $1.850 million of a net worth. I'm going to use about a 6% rate of return on these investments. We can do something a little bit lower, somewhere in that range. I don't like to get too high here. I like to be more on the conservative side. So now that we've done the asset side, let's go over to their expenses. And they simply say, hey, Tony, we need about $9,000 a month to maintain our standard of living when we retire at the age of 65. Okay, great. Let's take a look at step number one, which is income planning. Income planning is first, then we're going to look at investments as number two, and then tax planning is third. It's very, very important that you do them in that order. You can't do tax planning before you got the other two set up. Now, the average inflation I'm using is 3.27%. I've got a little inflation history button right here, and it shows us that the current 10-year average has been 2.82, and the 110-year average has been 3.27. We're going to use the higher of the one to help this couple out and be very protective. If you think it's higher, we will put a higher number in there for you. When you reach out to us, we're happy to put your specific numbers in. Now, $9,000 today is actually going to feel more like $10,236 in 4 to 5 years from now when they go to retire. So keep that in mind. Now, cash flows is going to be if we got gas rights, oil rights, or rental properties. They do not in this particular hypothetical case, so we're going to move right over to their retirement tab. And what we're going to check first is do they run out of money? Do they redline? And you can see I've got them living to age 95 years of age right here. And this is their house that is slowly growing at a little modest 1.5% inflation. And then I've got liquid assets that about $981,000 at the age of 95. Whether they live that long or not, you know, that's what they wanted to see their numbers run. Maybe you want it to age 90. Maybe you want yours to ran to age 100. Happy to do it any way that you particularly want. But let's take a look at where this money is coming from to clarify. So here you can see at age 65, they've got that pension income of $1,000, and then they're going to have about $6,000 in Social Security in the first year. So $7,000 total. Remember what they wanted. They wanted about $9,000. So because of inflation, they're going to have to pull out about $3,587 per month in that first year. And then you can see in the next year, they still have $1,000 from the pension. That one doesn't have a cost of living adjustment. It's flat for the rest of their lives. That's just the way that pension worked. They're all different. But you can see a small cost of living adjustment, and I used a lower cost of living for this particular case for their protection. So you can see it goes from $6,000 to $6,100 to $6,300 to $6,600, etc. So a small cost of living adjustment every single year. And you can see because of inflation, they're going to have to take a little bit more out every single year. Let's scoot this up for you. And then here is their liquid net worth out onto the far right. $1.5 million to start with. Even while they're taking $3,500 out approximately, or $35,000 to $40,000 a year, their account value is still growing for them, as you can see, all the way down. But you can see the withdrawals they're taking because of inflation when they're in their 70s becomes much, much more. And then they make it all the way to age 95 and they still have $981,000. Now, this is income planning. And this is in a perfect world. So let's go stress test this to make sure that if the worst case scenario happens, or one of them, what does that look like and how quickly will they run out of money? So I come over to this market stress tab, and you can see that in the first year that they pull out money, that $30,000 to $40,000 a year that they're pulling out, the market's down 10%. Okay, that's not a good sign. And then the very next year, they're still pulling out that $35,000 to $40,000 range, and the market's down 13%. And then in the third year in the retirement, the market's down 23%, and they still have been pulling all of this money out. Take a look in that ugly case scenario, how fast they run out of money. They are out of money by the age of 82, zero right there in the bucket. That is not a good sign. That is not a good income plan. I personally like something that's set up to what I call a growth bucket and a protection bucket. So when the market is down, right, you should be meeting with your fiduciary advisor 2, 3, 4 times a year based on your personal situation, and taking a look at, if the market's down, should we shift money from the growth bucket that is up and down in the market to a protected bucket? A protected bucket could be something like a CD, a savings account, a money market, or a fixed annuity that protects the downside protection. And I'll be very honest with you, I believe annuities, it's a very common word out there, are oversold. So much that I wrote my second book called The Truth About Annuities. I don't like about 95% of them that are on the market. I'm very selective of the ones that we do work with for some folks that it makes sense for. They are not for everybody, but for some. So in a down market, you want to use a product like that to pull money out of and allow the growth bucket to rebound and continue on down the road. So having a balance between both of those is vital and very important. So that's the investment side. If you have that taken care of, you're off to the good races. But I got to reiterate, I'm not a big fan of target funds in 401ks. And I'm not a big fan at all of mutual funds for many, many reasons. You can go to our YouTube channel and check out, I've done some avoid mutual funds at all costs and learn more about why I'm so passionate about that. So now that we've talked about income and we feel comfortable there, and you understand an idea of investments, of what you should be possibly doing and definitely what you should be avoiding, let's go take a look at what you're here for, and that is how do we avoid this tax bloodbath? You've done a great job of saving and accumulating money into your IRAs, your 401ks, your 457s, all that deferred money, but there's going to come a day of reckoning, a day that you're going to have to pull money out, whether you like it or not. That is called required minimum distributions. And in your 70s, even if you don't want money out of your qualified accounts that you've never paid taxes on, those are all deferred dollars. You are forced to take money out. And if you don't, it is a hefty penalty that you don't want to incur. The problem is if you don't do tax planning, you are spreading this tax problem out over your lifetime, and it gets really ugly. So I'm a big proponent of saying, let's at least take a look and rule out, does it make sense to do any sort of Roth conversions? I'm going to talk about those because most of you have heard about them, but there are a lot of other tax planning strategies out there that you can implement. You just got to find someone who's proactive and it will help you do those. So let's take a look. I'm going to go over to my tax tab. I'm going to come down to this tax tracker and take a look at this particular hypothetical case. And if you recall, they had about $900,000 in qualified money, $150,000 in after-tax accounts, $75,000 in those bank accounts, which are the checking, savings, money markets, etc. But here's where it gets very interesting. They have a lifetime projected tax from that age of about 60 all the way out to that 95 if they made it that long. And we can rerun the numbers shorter for you if you think you're only going to make it to 80, 85, 90. Okay, it's very simple to do. They have a lifetime tax projection of $1.4 million. I see this every single day in the business. And the big thing I hear is, Tony, I'm not getting any help from my tax preparer, my advisors. Can you help us? What could we possibly do? So all I did in this scenario to make this very simple to understand, okay? This is not the only strategy, but I simply did a Roth conversion just over 5 years. Not all of the money, but just a portion of the money. You do not have to convert all of this money. I can explain later in detail why. But just keep things simple for this video. 5 conversions for a portion of the IRA to help reduce this tax problem over their lifetime. And by simply doing that, it lowers their taxes from $1.4 million down to $860,000 for a lifetime projected savings of $529,000. Now remember, they only had about $900,000 in their qualified bucket. This is going to save them over $500,000 over their lifetime. Sometimes people fall out of the chair and they just don't believe that that's true, they can do it. So a lot of times I'll give them a lesser number to kind of get the toe in the water. This is a basic software. I like it, but I have other software that I like that's much more sophisticated. Your tax planning is not a one-time deal. Should be looked at over and over again. The laws need to be looked at every single year. How much that you should be doing. If it's done incorrectly, it could cause your Medicare premiums to go out of control and to be extremely expensive. But moving money out of a qualified plan appropriately in the right way and following all the laws and doing it constructively, you could put money into a Roth. You get tax-free growth. You get tax-free withdrawals, and all of the money inside of the Roth goes to your loved ones completely tax-free. It's what I call the perfect trifecta. It doesn't get any better than that. So another reason why I wrote the book, The 10 Tax Commandments, because I'm so passionate about helping family on the tax side. It's just something I really, really enjoy doing. I hope you found this very helpful. If you think taxes have any indication that they might be higher in the next 5, 10, 15 years, please reach out to us. We'll drop your numbers in here. We'll show you how you can benefit from doing Roth conversions and other tax planning. And always remember to consult a licensed professional who understands your specific goals and dreams.